Today we're discussing Fifth Third Bancorp, ticker FITB. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. We have a market cap of $25 billion, enterprise value of $35 billion. So you see about $10 billion in net debt on this business. But this company is operating in the banking industry, so we can kind of ignore that because all banks are going to have quite a significant amount of leverage when we tie into their business. So this is a bank that's as long on innovation as it on history, apparently. So let's see, few U.S. banks to have been named among most ethical companies. Doesn't really tell us anything. Is a federally chartered institution. And so that doesn't really tell us. Basically, this is a bank, and its goal is to be the nation's highest performing regional bank. Good to know there. Now, one of the things you want to look at here is return on equity. First thing we can see is that they did lose money in the financial crisis. That is a somewhat of a red flag for a bank because a lot of the banks that lost money in the financial crisis were taking quite a lot of risk. And apparently from people I've talked to, others that have analyzed banks, a lot of banks were actually able to avoid losses in the financial crisis if they weren't taking significant amounts of risk. And so that would be something I'm a little bit concerned about, but it's also not abnormal. Many banks lost money during the financial crisis, so it's something that just to be aware of there. You did see pretty good returns on equity before then, ranging from 19% to 11% in 2007. But literally, we want to look at the numbers since the financial crisis, see how they've been doing. In 2009, they earned 5% return on equity. They reached double digits by 2012 at 11%. They maintained around the double digit mark since then. They did have 6% in 2020, but over the last 2 years, they're at this 12% range, which seems pretty stable year to year. You like that stability year to year. It tends to show some predictability in the business model, but like anything with bankings, it's often that you can make a lot of money here and then all of a sudden a loss comes out of nowhere. Always something that's a risk with the banking industry and something to be aware of. Otherwise, though, what we see here shows indications of a high-quality business. You have 19 years of profits, only 1 year of loss, but again, banking can be a year where you lose almost everything in that year, so you need to be very, very careful. But certainly if this was a non-bank, all of the indications I see here are very, very good. Very low volatility year to year, very strong returns on equity. You're hitting that double-digit mark, which I'd like to see. Now, the return on equity of 12.3%. Now, when I compare this to a lot of non-banks, I'm really targeting a 15% return on equity. So I would like this to be a little bit higher, but generally the 12% plus range is a pretty good range. Return on assets of 1.3%. So you can see that there's that leverage of 9 to 10 times, which is common for many banks. So we're not seeing a super over leveraged balance sheet there with the way they're structured. Net interest margin of 3%, pretty normal there. Nothing that's alarming. Now, what's interesting is you have a really good return on equity of 12.3% combined with a PE ratio of 10. 10's a very attractive price to get a company that's earning a return on equity of 12%. As I've gone through this series, hundreds of companies, you don't often see that matchup, so that is very attractive. Now, PE of 10 is also combined with, though, relatively low growth in your net interest income, your gross loans, earnings assets, and deposits. These numbers are all in the mid-single digits, 3, 4, 5, 6%. You're not seeing high single-digit numbers like 8 or 9%. You're not seeing double-digit numbers like 10 or 12%, which would be really, really ideal. So what this tells me is this business is growing reasonably. They're doing pretty well. You can see net interest income going from $3.5 billion to $5.6 billion. So you didn't even double over the course of the decade, which of course shows it's growing less than that 7% number you would see if they had doubled. That matches up with this 4.5% number we see here. It's really not as high as I'd like to see. One thing I'm going to want to see as I go down through this more is a very high rate of dividends in order to justify not having a high growth rate. You're getting a good price of PE of 10, but we want to know where that cash is going, and that's really going to drive your results as a shareholder. So you can see these return on assets kind of jumping around. They peak at 1.5% in the last decade. So if we're going to see a leverage of, like, say, 10x at some point, then you're only going to get a return on equity of about that 15% range. Ideally, you'd have some higher numbers. In 2012, you did drop down to 0.8%, which brought the return on equity to 6.4%. You can see that there, kind of bringing it down a little bit. They have a pretty decent loans to deposits here, pretty high amount. But let's look at your earnings per share. You know, you began the decade at $2 per share, and now you're up to $3.35 per share. So you've grown only about 50% over the course of the decade. That's not that good. but you have been paying out a dividend. What's kind of weird, though, is your dividend is not that large. I mean, at the beginning of the decade, it was about 25% payout ratio. At the end of the decade, you're talking about a 30 to 40% payout ratio. So it is a little bit higher, but you're going to get the combination of your growth with your dividend rate. Your dividend rate is just not that high. You compare that $1.26. So let's see, the current price is 37 cents or $37. So you could say maybe that's about a 3% yield on your current dividend. So, okay, we got 3% on your dividend, and maybe you're growing at 4 to 5%. So now you're talking about maybe a 7 to 8% return on your investment, which is a little weird considering the fact that you're getting a 10% starting year yield, a 12% return on equity. So what's happening here? We're going to have to dive into the financial statements to really figure that out. So please hit the like button if you're enjoying the video so far, and I'm going to try and convince you to subscribe by the end of this video by adding as much value as possible when we go into the income statement, balance sheet, and cash flow statement. So let's dive into the income statement first. Now, one thing you see here is, of course, your interest expense fluctuation throughout the decade. You can see that despite your interest income growing pretty steadily here, your interest expense spiked in 2018 and 2019. Of course, that's when the Fed increased the interest rates during that time period. And then, of course, your interest expense dropped down significantly for 2020 and 2021 when the interest rates were cut back again. Now, they've grown again over the last year. That's, of course, because now we've been raising interest rates again in 2022. So you see that fluctuation in the overall business. But what I want to go back is go look at this 2018, 2019 numbers and see how they did in terms of profitability. And what we can see is, although the interest expense went up, those are actually some of your better years in terms of your EPS, which suggests the business does quite well in a rising interest rate environment. The other thing that I really like to see here is when I go down to this shares diluted, they have been making steady buybacks. I mean, look at this amount of buybacks is actually quite significant. You started the decade with 895 million shares outstanding. You end with 695 million shares outstanding. So they've bought back between 30 and 35%. No, not that much. 900, they started at 900, and they're down to 700. So about 20 to 25% of their shares outstanding have been bought back in the last decade, which is very impressive because you can see they bought back like 5% in just 2013 alone, another 5% in 2014, close to another 5% in 20. So the very steady, strong buybacks for this company. Now, they did have to increase shares outstanding 2018, 2019. I don't really know what that is, but I like the buyback culture that I'm seeing here, and it's a very big plus for the performance of this business. So you're actually going to get better results than what I said on that previous page because you're going to get more than just your dividend. You're going to get the buyback benefit as well, and that's going to be turbocharging your growth. My concern would be is that that's actually going to make your EPS growth look better than it otherwise is. Again, you've bought back 20 to 25% of your shares, and yet your net income's gone from $1.8 billion to $2.4 billion. So your net income's only up about 30%. That's what's driven your EPS to be up 50 to 60%. And so you're already getting some credit for that. So your growth is actually worse than it otherwise would look because of that. And so the EPS are making you look better than it otherwise would. Now, the balance sheet, of course, with these banks, it's going to be very hard to discern. You have to do a bigger bank analysis, calling up the call reports before you'd want to actually buy stock in the bank. So you can only get so much from the balance sheet of a bank because you don't really know, you might get gross loans. You can see they've been growing their loan base, but it's not going to show, what yields are they getting on those loans, duration and everything like that, which is what you'd want to know before making an investment. What you can see that's really nice is, of course, deposits are a key one for business. You can see them growing from 89 billion deposits to 163 million in deposits. 163 billion in deposits. So the deposits have almost doubled in the course of a decade. That's actually really good because that drives your ability to make loans and buy securities, which you see these loans and securities here. Of course, loans are going to give you a higher yield than securities, but tend to be higher risk. So understanding how the business manages that trade-off would be important as well. But generally, I like to see the banks that I own have a bigger loan balance because the securities, I don't really need them to not take risk on that end. I want them to make intelligent loans, give me that higher yield, and hopefully do it at a low risk rate. Nothing else in the balance sheet is interesting there. Cash flow statement, let's see what we can see. Again, with banks, this is a very difficult one to make sense of. You do see some acquisitions here, which is one thing that you'd want to be aware of. And look, one thing you can see as well, PP&E is very insignificant. That's not uncommon for a bank. You're not going to see a big piece there. But you do see stock-based compensation. I don't really know why you need stock-based compensation at a bank. This is normalized in the tech industry, but you're paying out $100 million each year in stock-based compensation. And what that's doing is it's making it harder for your buybacks to work for you. Now, they do make these buybacks, and they're making the buybacks, at 8, 15 times the size of their stock-based compensation. So it is working to buy back the share, but they're having to work just a little bit extra hard because they're giving out that stock-based compensation. So I'd really like, from a capital allocation perspective, if they just eliminated that stock-based compensation, but continued to make their buybacks effective. Now, those buybacks are going to be super effective when you're trading at these low PE ratios like this. My big concern, though, is when you really look at this, you're getting this nice growth in your EPS because you're turbocharging it with your buybacks. And so we don't really want to double count this. And you're really going to get your max return as a long-term shareholder is really going to be upper bounded by your return on equity. So let's call that 12%. So maybe your max return in this investment is 12%. Now what it should be is your minimum return should be a PE of 10. Or should be a 10%, so 10 to 12% is a really good number to hit, but your growth isn't as high. So again, some of this cash flow, and this is where it looks better than it is, because what the stock-based compensation is doing is it's turbocharging the net income number to be higher than it otherwise would be, because you're having this stock-based compensation, and then you're having to use net issuance of common stock, paying more than that in your buybacks in order to really cover the cost of those employees. And so your net income is a little worse than it shows here. So I think really the returns you would expect for this are worse than the 10% you would see here. Most likely you're somewhere in this 8 to 12% range is what you'd expect for returns in a business like this. When you're getting a 3% dividend yield, you're getting like a 5% buyback yield. That's going to add up to about that 10%, that 8% range. Maybe that's your low end expectation as long as prices stay low. Your high end would be maybe this 12% range for return on equity, assuming you get a little bit better growth. Maybe they get a little bit better with their capital allocation. Maybe you get some good prices. That's kind of how I would benchmark this investment. Now, 8 to 12% is just a little bit low for me as a potential shareholder, which is why it won't go on my watch list. I would really like that shifted to be like a 10 to 15% return. So if my return on equity hit 15%, and my growth was close to an 8% rate, then I could really pencil in that 10% lower bound of my return, and I would get really, really attracted in this business. But for you, perhaps 8 to 12% is a good range that you would start to get interested. So it could be applicable for you, even if it isn't for me. Something to consider. But again, read those call reports, annual reports to do that deeper dive into this business. If you enjoyed this video and you learned something, hit that like button and don't forget to subscribe. I'm working through every company in the S&P 500, and you can see the watch list stocks, the ones that have made my watch list and hit my high standards, in the playlist above. I hope you'll check out those videos. There's some great ones in there, and I think you'll really recognize some of the names and potentially find some stocks you haven't seen before. So I hope you'll check that out. If you want to learn how to use this software that I am using myself and think it would be valuable to you, go to quickfs.net. My affiliate link is in the description below. Let them know that Trey sent you. And thank you for listening. Until next time, stop paying fees, start building wealth.